Hello everybody, Alex here. Welcome to my finance and accounting education channel. Today we have a very interesting topic. I could say it's about cryptocurrencies, but it's not really. It's more about company valuations, about tech companies, how the markets are perceiving various companies during the lifetime, and a little bit more details about this PE ratio. What is the significance of the PE ratio or price to earnings ratio? And what can you tell when you see a certain PE ratio about a certain company? It's all related about an exchange of ideas between, let's say, two quite well-known people, the CEO of ARK Invest, Kathy Wood, and head of blockchain.com. Just as I have said, it's about cryptocurrencies, but not really. It's a very interesting topic from my point of view, because it's helping everybody understand and learn a little bit more about these topics. But before we jump right in, I'm going to ask you to subscribe to my channel. It's free, it doesn't cost you anything, and it will help me a lot. If you hit also the bell notification button, you will never miss an update on my site. I do them quite regularly these days. On Tuesdays, Thursdays and Sundays you should expect new and hopefully interesting videos on my site. Now, just as let's say as an introduction, we spoke last week about the rage outburst of Peter Thiel, that he was not very happy, and he said that he is going to expose, or the entire crypto community needs to expose the non-believers or the opponents of the cryptocurrencies. And he nominated exactly three persons: the CEO of BlackRock, Warren Buffett from the Berkshire Hathaway, and Jamie Dimon from JP Morgan. And back then, and it's now like it's clear for me, the idea what they are what they are saying, selling to the large public, is that the cryptocurrency will get widely adopted. They will be used in daily transaction by everybody in the world, and so on and so forth. But then you have to ask yourself what is required in order to get to that stage, and what they are actually trying to do, and what they are asking from others to do. So in order that, let's just say that the cryptocurrencies are widely adopted, let's just say that the companies will have to accept them as payment. The prices should be also expressed in these cryptocurrencies. I wouldn't go that far. I wouldn't be that naive to think that the governments will give up on their national currencies and express their budgets in cryptocurrencies, or accept tax payments in cryptocurrencies, and so on and so forth, because that's the states will never give up on their sovereignty and on their right to issue this legal tender, the fiat money, the dollar, the euro, the Great British pounds, and so on and so forth. So you'd expect that somehow the crypto community is pushing more into this direction of regulation, wide acceptance, having companies accept, let's just say, the payments in cryptocurrencies, auditors, all the supervising bodies having a clear legislation, in this kind of direction. But on the other hand, you see that they are actually pushing for more allocations, because this is what Peter Thiel said, that they are pushing for more allocations from investment funds, hedge funds, investment banks, and so on and so forth, which kind of got me wondering, like, it's so transparent what they are actually trying to do. They don't really care about the wide adoption of cryptocurrencies. They know that they might get some gains from that direction too, but that will happen very slow, and it will be very complicated. But if you just pressure some decision makers that are administering a lot of money to just to allocate some money to certain cryptocurrencies, you will get a return on investment very fast. So you will get a profit very, very fast. And that's actually what they are after. It's not about democracy, empowering the people, having a stable currency, and so on and so forth, and everything that they are selling to the large public. It's about quick and large returns, actually. Now, coming back to our main topic, so we have the crypto firm hits back at Katie Wood. I think the market is pretty clear. Her position is down 50%. It's very interesting. We will see. It's an article from CNBC from April the 13th. ARK Investors CEO Katie Wood took a swipe at blockchain.com as she spoke about valuations in the private and public markets. She said it makes no sense that the valuation of blockchain.com, which is a private company, rose threefold in the last year, while the rival Coinbase, which is publicly listed, has fallen sharply. Oh yes, it makes total sense from my point of view, and we will see later why. When pushed to respond to Wood's specific comments on blockchain, Calm Management co-founder Nicholas Carey said, I think the market is pretty clear. Her position is down 50% and ours is up 3x so. The idea is that, of course, and I cannot imagine that Katie Wood doesn't know this. Before a company gets its IPO, so it gets publicly listed, it's getting normally support from venture capital, and they have an interest in pumping this valuation. Yeah, so let's just put it like this. And why they have this interest? Because once the company gets listed, they are somehow recovering their money through the prices that the new shareholders are paying for the stocks. I've done before another video about it was called Bearish on Tech IPOs. I'm linking it right now with the CEO of New Constructs and so on and so forth. And the idea is that there are so many tech companies, so many new ideas, but not many of them prove to turn into real investment, into real companies that can deliver profits and have serious growth and so on and so forth. So while it might be tempting to invest in such endeavors, let's say, the degree of risk associated with trying to support everything that has this tech label on it, it's quite significant, let's say, and the public markets won't have it. That's simply it. I mean, they accept a certain the individual investors, the institutional investors, they accept a certain degree of risk, but it's somehow capped, yeah. Because if they would be willing to take more, they would, and especially the institutional ones, will go into this venture capital direction, and they won't buy shares from the stock exchanges. Yeah. Now, Blockchain.com co-founder Nicholas Carey hit back at Katie Wood after the investor took a swipe at the crypto business by questioning its valuation and management. If you look at the others like blockchain.com, its valuation over the past year has tripled, while Coinbase in our portfolio is down 40%. That makes no sense, Wood, the CEO of ARK Invest, told CNBC on Tuesday. Now, where is she wrong with this? First of all, if the company called Coinbase, it has a very discounted price, like with 40%, it's now her opportunity to buy more. However, the fact that she's not talking about this, wow, it's a great company, we shall develop a lot in the future and so on and so forth, and we will double our position in this company, actually means that she doesn't trust the future of the company. I mean, realistically speaking, if you read between the lines, she's just pissed off that her investment is down, but she's not expecting the company to thrive or to do much better in the future. That's the reality. Coinbase is a far better and well-diversified company, right? And I would argue better managed company. Then buy more. Why are you complaining? I don't get it. Blockchain.com is a cryptocurrency trading platform and wallet, as well as a direct rival to Coinbase. Blockchain.com is still a private company. Yeah, so that's the difference. One is public, Coinbase blockchain is not public. Katie Wood's ARK Invest Fund holds shares of Coinbase, which is listed in the United States. Shares of Coinbase are down more than 50% over the past year. Wood's comments came in the context of an answer about valuations of technology stocks and interest rates rise. She spoke about the difference between public and private market valuations of technology companies. This, blockchain.com, is up threefold in 1 year and Coinbase is down 40%. Does that make any sense, you think? I think the private market has this more right than the public markets. And the reason the public markets aren't efficient is that they are not doing the research, Wood said. That remains to be seen. First of all, I think that saying that the market is wrong is wrong. The market is always right, and even if it's wrong, it's only temporary. For example, I don't like the valuation of Tesla. I never liked it. I don't believe that Tesla will reach the scale that is required to justify 200-300 price to earnings ratio that it had in the past and also currently. That I think that at some point the market will realize that, and even if now the things are not very clear, will get more clear in the future. Carey, co-founder and vice chairman at Blockchain.com, hit back at Wood's comments. Well, there's definitely a difference between private markets and public markets, and Katie's position has taken a pretty big haircut. I think that's interesting to note is, yeah, our company's valuation did triple, and that was in the context of a global pandemic, a collapse in tech equities, and a land war breaking out in Europe. Carey told CNBC in an interview on Wednesday. Coinbase position is not well understood in the market. In the long term, though, I think both companies have a lot of upside, and our recent investors are very excited about our future. We've been working very hard to build a composition of revenue that's minting better quarterly results. When pushed to respond to Wood's specific comments on Blockchain.com management, Carey said, I think the market is pretty clear. Her position is down 50% and ours is up 3 times so. Carey said that Blockchain.com is taking a patient approach to going public and that is currently well capitalized. Tech equities have obviously taken a pounding. Katie's positions are down all over the place. We're going to take our time with it. We need to see the crypto market sort of better understood by the public market, Carey said. Now, if you hear that the company is down 40%, you would expect, and I was expecting, I didn't know anything about Coinbase, I took a short look into it. You would expect that the company, and because it's in, let's say in tech, okay, it's tech crypto related, but it's still a tech company and it's quite a new one. You'd expect it to have losses. However, they have a profit. And let's see exactly what we are talking about. So it's clearly that when they have a P ratio of 10 for $147 per share, that means that they are doing $14.7 per share earnings, which is quite good, I would say. The trouble is with the P ratio. I mean, it has the P ratio of an oil company, which means that currently the market is thinking about this company that it has no growth perspective, that it will remain as it is. That might mean that, and this is also my feeling, that the cryptocurrencies have already reached their maturity and there are not, of course, that guy is talking about upside potential and so on, but there is no upside potential. So most of the tech companies, and you can check Amazon, Facebook, so the large one, Amazon, Facebook, Alphabet, even Microsoft, Apple also, you will see that they have P ratios 20 plus, 20 to 40, some of them. Tesla, of course, is an exception with that 200, 300, whatever they have right now. But that means 20 P ratio means that the investors are still expecting growth in the future and quite substantial growth. Once the P ratios is getting into the area of 10 or below 10, that means that the company is kind of done with what they can offer to the world in terms of revenue growth and profit. It might not be a very bad investment. They might start paying dividends at some point and so on and so forth, but they are no longer a growth stock. And just as I was saying, since it's a company which was listed on 16th of March, over April 2021, so it's quite a young company. It's exactly 1 year old. That's very interesting. It's exactly 1 year old. This is what the valuation tells. On the other side, for blockchain.com, I tried to explain you what's the story with the venture capital, and let's just say that this value, the value of a company is not something which is perfectly objective and God is coming from heaven and saying this company is worth that much and you need to take it as it is. They are, of course, subjective, all this valuation, there are some models used and so on and so forth, but we need not to ignore the interest of venture capitalists that are supporting those companies before they are getting their IPOs, and the fact that they cannot be 100% objective. It's their loss if the company never goes public, or the price at the IPO will be far lower than what they have evaluated, and so on and so forth. But that's why they are venture capitalists, because they are willing and they are taking more. Sometimes it pays off to invest in a lot of businesses and just to have one or two that are very successful and bring you a lot of returns, but you are losing with all the others. But that's, let's just say, that's their risk. That was it for today about the discussion with Katie Wood and the way she sees. She definitely is a fan of technology and of innovation. I can understand that, but she also needs to understand that not all, even after the IPO stage, not all the tech companies are delivering what investors are expecting. We need not to forget the dot-com bubble also, when everything which was had an internet domain was thought to be the future, and a lot of money were thrown in, and most of them, for example, we have Amazon from that period, which proved to be quite okay, but most of them proved not to be able to generate profits or even worse revenue. So that's what I'm saying. Be careful with the tech IPOs. They are very interesting, very sexy. They get marketed in a way that can make you think that it will be the next big thing. It will be the next Apple, let's say. But with most of them, it's never going to happen like this. That was it for today. My name is Alex Petrescu. Thank you for watching me. If you like this video, please do not forget to hit the like button, to comment if you have something to add on the topic, to share it with somebody that might be interested about company valuation, pre-IPO, post-IPO, technology companies, blockchain and cryptocurrencies related companies, and so on and so forth. But most importantly, do not forget to subscribe to my channel, to hit the bell notification button. You will never lose an update on my site. I do them quite regularly these days. You should expect new and hopefully interesting videos from me on Tuesdays, Thursdays and Sundays. Below this video you have links. You can create an eToro account and trade there without a commission or a fee. If you trade with your own money, you will own the shares. If you want to trade leveraged, you will actually trade CFDs. But it doesn't really matter how often you are trading. Not paying a commission or a fee is always a saving for you. Below that one you have also another link with an Amazon wishlist with hardware and software items which can help me improve the quality of my videos, thus being beneficial for you because you will get better videos from me. But let's just be honest and say that from financial perspective, this Amazon wishlist is the most inconvenient for you. The easiest way to support me is to subscribe to my channel and to hit the bell notification button, and of course to continue to watch my videos. Once again, I thank you today for your time and patience. I hope you enjoyed the video, and I look forward to presenting to you with next opportunity. Goodbye!